Hello, everyone. Welcome to the market update for Tuesday, August the 9th. As always, if you have any questions during the week or any questions that I don't get to or answer here during the live class, make sure you send those to Jerry at traderspro.com. And don't hesitate. I want to make sure that everyone's understanding the things I'm talking about. Now, I will note though that there are a lot of training videos that are on the YouTube channel. So if you go to youtube.com, go to the Traders Pro channel, subscribe. You'll see a lot of video content there, different trainings on a lot of different topics. And so if you're really wanting to speed up your education and get into more specific areas than we talk about in these updates, although I'll bring up a lot of stuff that I cover in those trainings, a lot of little things that are covered in more detail in those trainings, but I would encourage you to go through those. There's a lot of stuff, so again, I'm not expecting you to get it all down in 1 week or anything like that, but if you just start making it a part of your routine to go through some of those trainings, you'll have a lot better understanding of my approach and what I'm looking for, and you'll start understanding how these markets move and how to read that movement a lot better and how to manage it when you're managing your trades and things like that. So I would encourage you to check that out. All right. Obviously, we're getting a little bit of a continued whipsaw in the market, a lot of indecision, and we would expect it. I talked about this key resistance area. I talked about it a number of times over the last few months. We've hit it and reacted to it several times, and this is no different. But there are a few mixed signals here that are going on just over the last couple of days. I was feeling a lot more confident we're going to break out last week, and we failed to do so. But I also will point out that we did get a couple of signals that breakout should be coming at some point. But in the near term, we could see more sideways movement, maybe even a little bit more selling. I know a lot of people are focused on tomorrow's CPI report. Really, it's the biggest binary event, so to speak, in August. There's no Fed meeting. The jobs report last Friday was looked at as being pretty big, but the market kind of shook that off a little bit, although you could make the argument it's kind of reacting to it a little bit early this week. But not in a huge way. It's not selling off massively off of that hot jobs number. So there will be a lot of focus on the CPI, and maybe that's what the market is doing. When we look at the charts, we're seeing them move a little more sideways here. Maybe it's just kind of waiting for that news to come out to decide what to do next. But I will talk a little bit about kind of the bullish and bearish arguments here as we start to get into the charts. But before we do that, the direction alerts, they were signaling that we were getting a little stretched, a little overbought. We were getting into the extreme range. We weren't at the far right side of the extreme range, but we were in the extreme range for the momentum indicator and the breadth indicator. Well, actually, breadth, I think, got close to extreme. I can't remember if it went into the extreme range or not. But we were getting some signals that the market was getting a little stretched, and so it's not surprising that we moved a little bit sideways or pulled back a little bit in some cases. That's what these indicators are there to show you, is when are you in a condition where you're stretched a little bit and when you could expect to see a little bit of a sideways or pullback type movement. Now, it's important to keep in mind that we're still not going to be looking at one thing to tell us what to do. Meaning, if we get some of these momentum indicators that get stretched, they're in the overbought area. It doesn't mean we're immediately going to short a stock or necessarily get out of a trade just because we're in that extreme condition. You can stay in that extreme condition for a little while. What we want to do though is recognize that we're in it and then start to look for any weakness. So you combine for instance, we were hitting that extreme level last Thursday, and then Friday we get a little bit of a bearish reversal candle that took place, a bearish type candle that took place. Okay, you combine those, it would indicate that there's a stronger probability of seeing the market pull back a little bit or move sideways in that area, and that's how you can use it more effectively. You don't want to be assuming that you're going to get an immediate result off of any of these indicators. You start guessing that way and making trades just based off of overbought and oversold conditions, and you're going to get beat up pretty good over time. It's got to be combined with something else that you're looking at. More specifically, I want to look at the price action, the candle for that day. Is it indicating any sort of warning based off of that condition that you're in, whether it's overbought or oversold? So Brett, sentiments remained high. That hasn't really changed much. The buy-sell ratios, we knew they were a little bit wide. They've kind of flattened out a little bit. They haven't started really coming closer together, so we really haven't seen enough selling to where we're seeing a lot of stocks move from hold to sell or from buy to hold. That would cause these indicators start coming closer together. You're right at about some historically wide ranges here. So again, this is an area where we could see a little bit of consolidation or possibly see a little bit of a pullback, but we could also see where it can get even more stretched. This is on the sell side here, but it's definitely possible that it could get a little bit more stretched. Again, this is another indicator. You don't want to be basing your trade off of this alone, but this is just kind of telling you how stretched you're getting in those conditions. This sentiment indicator is backed off of that extreme, but there again, we were above that extreme. Not surprising. We got a little bit of a pullback that alleviated that a little bit, so we're still an elevated level, though, as far as we're still leaning a little bit more towards the overbought condition. What that does tell me is if we do start to sell off here, if there is a little bit of a bigger sell-off that takes place, that there's a lot of room for it to pull back to alleviate that. If we break out here, there's not a whole lot of room before you start getting back into those extreme overbought conditions. Although, as you've heard me talk about this over the last few weeks, one of my theories is that we could break out here and get a chase, get people kind of that melt up, and one of the characteristics of a melt up rally is that you get overbought, you stay overbought for a period of time, and people are waiting for a pullback that never comes, and then they start chasing at that point. And that's something that I could see this market doing. Doesn't mean it will. And again, I think it's important, especially for those that are new, that are listening to some of the things I talk about. I'm not trying to predict things when I'm going through these different scenarios or talking about these different scenarios. I'm trying to be prepared. And so you'll hear me talk about both bullish scenarios and bearish scenarios. The purpose of that is to be prepared. It's kind of like a football coach preparing for a football game. He wants to analyze. He doesn't know what the other team's going to do. So you want to be prepared to know, boy, if they line up this way, typically they run the ball. If they line it this way, typically they pass the ball. You want to be prepared for the unknown that's coming at you as best you can, so that it doesn't catch you off guard. You're not seeing something that is shocking you. But more importantly, that you've got a counterattack if you see something that's coming at you. One of our counterattacks that we use is using some of those inverse ETFs that allow us to buy them like a stock. They'll go up in value when the market goes down in value, and so we can still be bullish. We can still have these things go up in value despite the market going down in value, and it hedges us a little bit. And I'll talk about one of those I've added to the portfolio here a little bit later in class. All right, so let's get to the charts here. Excuse me. And look at the S&P chart. Now, again, what we're really focused on is this breakout area right here. the June highs right through here. We've reacted to that area several times before. This whole area right in through here has been significant for several months, for most of the year. Okay, we held this as support back, and we pulled back to it right in here. We tried to hold a support right here. We broke through it here. We rallied up to it here. We broke down below it from there. Now we're back up into this area here. If we can break out above this, I think that's a lot more bullish. I think we should start to see the market to kind of take off. And what's happened, and this is something I talked about last week, is I said we could get up into this area and then start moving sideways a little bit. And that's kind of what's happened in the S&P. So despite the weakness yesterday, well, we had kind of the weakness Friday where we gapped down. Now Friday was interesting because we had the initial gap down off of that jobs report, but the market rallied from that for the rest of the day. And again, if you're not able to read the price action, you could have looked at Friday as being a down day or a flat day, really not telling us much of anything. When actually it was telling you there was a bullish reaction, because here's where we opened, here's where we closed. Now we still closed lower than the day before, but there was bullish momentum going into Monday. Monday was the big NVIDIA surprise, bad news. We opened higher, and then we're trying to break out, and then that news came out, and it kind of gave it all up. Now, that was a bearish candle. So we opened higher. We closed lower than where we opened. We had tried to go higher right here, so we closed near the lows of the day. That's a bearish candle. Usually, again, remember, these candles are very short-term in nature. They're not telling you that a stock's going to go up for a long period of time or down for a long period of time. You could combine them with other chart patterns to come to those conclusions. But usually when you see that type of price action, you would expect weakness the next day. And it could just be right at the open. Just like this is a bullish reversal candle on Friday. So you would expect that the market should show some bullish momentum early or sometime on Monday. It should show a reaction to that bullish reversal. And sure enough, we opened higher. We gapped up. We ran up a little bit. We did react to that candle. It just didn't hold, and then it reversed. So with this bearish reversal candle yesterday, we were expecting that the market should be lower, or open lower today, or at least trade a little bit lower today. Maybe it did what it did on Friday, where it gapped down and started to rally back up immediately. That's not what happened. It gapped down a little bit. We're trading a little bit lower than where we opened, although we're still in a little bit of a compact day here. We haven't moved down very much. We're still in this sideways range right here. And so as of right now, we don't want to panic yet and assume that the market's falling apart, because it's not showing us that yet. But it is showing some weakness today, and we've got to respect that. And I think it's key. What's really going to be a focus of today's update is the fact that the chip stocks are collapsing. And remember, they're a leadership group. They're the ones that should be leading the rally. And so that would be one of my biggest bearish arguments, is that the chip stocks are rolling over right here, breaking some of their trends. And that's concerning, because it doesn't necessarily mean that the market's going to start panic selling here, but it could mean we get a little bit of a deeper pullback. Maybe the S&P pulls back into this area right here and then tries to break through. We have to respect the fact that those chip stocks are trying to tell us something, and they're like I said, they tend to be a leadership or a leading indicator of things to come. So we want to pay attention. It's not an exact indicator, and it could take time for it to reflect what it's showing us through the system. But it's something we need to pay attention to. Now, what would be more of a bullish argument based on where we're at right now? Well, Thursday I talked about this, that one of the reasons why I was very bullish on Thursday was that we saw the I got to get to the Nasdaq 100 here, the Qs bond. There we go. The Nasdaq 100 actually did break above that June high. So here's the June high. We flirted with it right here, but last Wednesday, we clearly broke above it right there. Okay, now remember, a lot of Nasdaq stocks are technology stocks. Technology has been a leadership group in the markets for decades. So usually they're leading the way up and they're leading the way down. And in this case, it looks like they were the first to break out. It looks like they're leading the way up. Okay. Now, I think I talked about this on Thursday, if I'm not mistaken, but I said the one I think is going to break out next is the Russell 2000. We've talked a number of times about small caps being a leading indicator as well. And yesterday, the small caps broke out above that June high. Now, it wasn't the strongest candle. We came off the highs of the day. That's what we call a shooting star candlestick formation, which is a lot more bearish if it closes lower than where it opened. But it was still not a very strong price action. Not surprising that we came down today, but we did break out. We broke out above that range. We came right back down today, and the small caps have been the weakest group index today. So it's kind of a flip flop right there, going from breaking out to coming right back down again. But you can see why I started off the discussion today saying that the market's giving us some mixed signals. There's a bullish signal that we broke out, and then a bearish signal that we come right back down below that breakout area. So we've got two indexes, though, that have broken out above there. That would tell me that we should see the Dow and the S&P eventually break above that area as well. The problem is it doesn't have to always do that immediately. I talked about how the Russell 2000 was not confirming the bull market late last year, or most of last year. It took months before we finally saw that the breakdown take place and the bear market start. Had you started shorting because the Russell 2000 wasn't confirming the S&P rally, you would have gotten killed. Okay, so these divergences and these, when we talk about leading indicators, they're not always immediate, and you never want to base your trade decisions on something like that alone. But it's something we're paying attention to. And again, what we're trying to do right now is get the direction right. We're not trying to predict anything. We want to get the direction right. If we are going to break out right here, we get a nice bullish run. I want to participate in that. If we're not, well, then we need to be more cautious, remain more on the sidelines, not get too aggressive to where we're going to hurt ourselves if there is another downturn. Now, one thing that I talk about a lot to try to gauge here too is we're trying to gauge market mood. What is the market mood? Now, a lot of this has to do with just reading price action and reading charts, but also paying attention to news events that come out. Okay, so what's a good example of reading the market mood? Well, if we go back, let's go back to the S&P chart here. We get this jobs report that came out on Friday. Everyone's telling us that's not good. It's very bearish. It means that there's a good chance we're going to start to get wage inflation, which is really what the market's trying to prevent right now, compounding the problems that we're already seeing. And so what happens is the market does open lower, which you would expect it to do. The gap down on that news, open lower, looks like things are bad. But again, it traded up. It immediately started to rally into the close right there. So in other words, what happened, even though it shows still a loss for the day because it still closed lower than the day before, it's telling you that the market is shaking off that bad news. It's saying, we're still buying. We're going to ignore that's. I'm not selling on that news. I'm going to be buying on that news. And we want to pay attention to that. Okay. Now, again, sometimes there can be false moves with some of these things. I've talked a number of times in the past about Fed meetings. There can be an initial reaction to the Fed report, and then it can go the opposite direction, which is the true direction a little bit later on. So we don't want to base too much of that analysis on one day. But if we start to see this a lot, what happens tomorrow if the CPI number is viewed as being bad and we gap down again? Do we see the same thing? Do we gap down and then rally up off of it? Or we don't drop very far off of it? Or pay attention to the VIX. Does the VIX spike up in relation to whatever move the market is making off of that? Pay attention to that stuff, because that's what I'm talking about when you're trying to read the market mood. Is it shaking off bad news, or is it embracing bad news? Because when you can read the market mood, what that means is that when you see it shaking off bad news, and it's not necessarily rallying on bad news, we're not rallying strongly, but it's not dropping strongly. What that tells me is the market is waiting for any reason to buy, any strong reason to buy. And that means that there's any news that comes out that is somewhat bullish or less bearish even sometimes, you can see the market really take off, because it's wanting, it's in a mood where it wants to just have any reason to buy. It wants to buy, and it's looking for any reason to buy. Now, the opposite can be true too, where you get you start dropping, and it doesn't matter what good news comes out, the market just shakes it off and it wants to go lower. It's looking for reasons to sell, and that means any sort of bad news that comes out is really going to cause it to drop sharply. Any good news that comes out is probably not going to have much of an effect to rally it either. We saw that a little bit a few months ago when we were caught in the downtrend there. It was doing just the opposite. It was shaking off and any good news. It was embracing the bad news. But I think that's part of why I've been turning a little bit more bullish recently, is because I've seen that shift in the market mood. Now, all it takes is one big disastrous day to shift that mood back to being bearish again. So I don't want to imply that we want to get aggressive here because we're sensing a bullish market mood, but it's just we want to recognize that and just tuck that away. The market right now is reacting pretty bullishly to some of these news events, so we're going to pay attention to that tomorrow. I'll probably talk more about it on Thursday when we know what that CPI number is tomorrow, and we can kind of see the reaction to it. So S&P chart, again, we want to see if we stay in this tight range. That's pretty good. That means so we're looking at this support level right here. So right around that 408. This goes all the way back. Remember this big, you can't really see it very well. That was a big bullish reversal candle. It gapped all the way down here and then rallied immediately off of that. That kind of marks the lower part of that range. And then here's the upper part of that range around that 415. 416, we get up 417, 418, and I think that's really the key one here is going to be the S&P, because everyone really follows the S&P. When it breaks out, I think that's when it could start taking off. But again, you can't ignore the possibility that we get a deeper pullback here before breaking out. We got to respect that possibility as well. The Dow, again, you can see it hasn't broken above that June high. It's been moving real sideways right here, kind of the same thing. Bearish reversal candle yesterday. It's real flat today. Really tight trading range here. Really not dropping much. Again, that's a pretty good signal. But it's an indecision. Indecision doesn't mean it's going to reverse back up. It could. It's just a pause. It could mean that it's going to work its way still down to the lower part of this range. But those are the key areas to kind of watch to see what happens there. We looked at the Nasdaq. The Nasdaq 100. You're going to want to pay attention to this because the chip stocks are a big part of the Nasdaq 100. If you start to see it, you can see it's kind of pulled back to that June high. We want to see that hold. We don't want to see it breaking below there. That would not be very good if it just plows through that. So that's something to watch for the next couple of days as well. And then now we move on to bonds. Bonds, again, we're stuck in the sideways range. So, the bond market's not signaling any direction either. We talked about how it started to break out right into here and then came right back down below it. We had this big down day on Friday that looked like maybe we were starting another impulsive move down, and then came right back up yesterday. Overall, we're just moving sideways right here. Now, again, that behavior in the context of what we're looking at here, I talked about this being a possible inverse head and shoulders pattern. You still have these higher lows on the rally up through here. It's still kind of acting like it wants to go higher, that we could be in this trend reversal in bonds, but we really need to get above here and this May high. We got to really clear that in a big way. Notice how a lot of these things line up about the same way, right? We're looking for breakout above the June high on the S&P. We're looking for this breakout on the May high on bonds. Everything's just kind of sitting in this area here, not really doing anything. But in these conditions, you can kind of get a feel that something's building. Something's building right here. And again, it could be building for a big move up or big move down, but you can kind of sense the trading energy that's starting to build for an explosive move. And I'm just hoping that we get a signal in the price action, which we usually do, ahead of that to where we can trade it. Do we start to see what I'm really looking for a bearish signal is, do we see a down day with a big spike in the VIX, which we really haven't seen yet? That would cause me to really jump to turn more bearish pretty quick at that point. Until then, like I said, I still think it's acting more like it wants to go higher. The bond market's really not giving us a direction there yet either. Gold, I haven't really liked the chart of gold. It's hard to tell right here. Is this an impulsive move? It's looking more impulsive than it typically does. So there's a chance that gold could be reversing back into an uptrend right here. They are bumping in. It is bumping into some resistance. Do you start to see it maybe move a little bit sideways here? Actually, that would be a pretty bullish sign if it moves a little bit sideways, because that would probably make this a little bit more clearly impulsive. That would be clearly a corrective, which would usually lead to another impulsive move up. And the reason why I say there's still some question marks is because I've seen some of these moves that look somewhat impulsive and they ended up being corrected. Could this be choppy right here, be viewed as choppy and corrective for a move down? Yeah, gold's been really hard to read, and partly because the gold markets have really been, a lot of those commodities have really been manipulated by some of the big banks in recent years. There's a lot of tricks that they use, and so I haven't really trusted a gold chart for. And this kind of backs up. I'm pretty good at reading charts and pretty good at reading price action, but I used to get beat up a lot on a lot of my gold trades, and I couldn't understand why, because I'm reading just what any other chart would show me and tell me. And then I heard stories about particularly J.P. Morgan manipulating the gold market. They pay fines when they get caught. But whenever a company, or in this case a bank, is more than willing to fork over the $1 million fines they're getting fined without any questions, that they're just making tons more with the activity that they're doing, that they don't care. It's like a cost of doing business. All right, here, government, we're gladly going to pay you your fine here because we're making 50 times that amount in the stuff we're doing. But yeah, it's caused me to really not want to get involved with some of those commodity like gold and silver. Oil, oil's been kind of tough to read too. We've been kind of whipsawing a little bit back and forth. I talked about this as a possible bullish ABC pattern. I thought we were taking off right here again, and then this kind of ended up being more of a bearish ABC pattern for another move down. Now we're back down to these levels right here. You're looking at, is this going to hold as support? Is this a little bit of a double bottom right here? You do have a slightly higher low if that holds. A little bit of a bearish indecision candle today. I'd have to clear above here for me to turn more bullish, and because that would put it to a higher high. We have a slightly higher low right here. If it gets above this high, it'd be a slightly higher, or be a higher high. And could it be that we see oil just kind of move sideways for a little while in a range? And I think that's probably a little bit more likely, particularly because you look at everyone's kind of happy that they're seeing oil come down a little bit. At least when they go to the gas pump, they see oil or gas prices have come down a little bit. But we know that there's a demand. That we know that there's reasons. There should be reasons for demand for oil around the globe with Russia, Ukraine, that whole situation. The concern is if oil is dropping here, it's a reflection of recession or slowdown in the economy. The lower demand because of lower economic activity. That's the concern here, is that and why oil prices dropping, as long as they don't drop dramatically. If they drop dramatically, that'd be a pretty big warning sign that those oil traders are looking at a bad recession, a big slowdown, and you've got these oil producers that have started to crank up production with the demand that's out there, and you have a world slowing economy requiring less demand for oil. That combination is going to cause oil prices to drop pretty dramatically. Now, if they can, you start getting news that inflation is getting under control, that the slowdown in the economy may not be as bad. It'll be that soft landing, quote unquote, that everyone's dreaming about, but probably is never going to happen. Then, maybe you start to see oil start taking off again. But I think it's a very choppy trade right now. You could see a lot more of these whipsaws with oil. And I wouldn't be surprised to see it move a little bit more sideways. Now, we saw this happen earlier in the year where we saw kind of this whipsawing type condition. We did end up breaking out and going higher. You could see something similar where we just start whipsawing back and forth a little bit, maybe a little bit more leaning towards the downside with some of those whipsaws. So we'll keep an eye on that. But right now, this is what I would focus on: is does this hold right here as a double bottom or a slightly higher low? Can we break out above here to a higher high? Right now, we're in no man's land right here. We don't know. We were going to call this, just expect a sideways move in oil until we can break out of either of those levels. And we'll save that for a future update when we finally do break out. We'll comment on it if it finally happens. The dollar, again, it's moving more sideways. Last week, I was talking about the possibility that this was completing a bullish ABC pattern. We started to see some early strength in the dollar there, and then got hit with Thursday's drop right here. Came right back down, then came right back up again. Basically, we've been more sideways through here. We have been able to hold this breakout area, so that's going to be key. Does it stay above there? If it breaks below there, that'd be a lot more bearish for the dollar. It's still acting like it wants to go higher, in my opinion. But like with everything, I think everything's waiting. All these charts are kind of waiting for tomorrow, news that comes out tomorrow. And I think that's all the market is really focused on. I mean, there are earnings reports that keep coming out, but most of the big influential companies have reported. I know the NVIDIA news that came out is maybe startling the markets a little bit, and that could happen where we have companies that start revising numbers downward, and at some point, that could be something that changes the market mood. But so far it looks like the market's not overly concerned with that Nvidia news. But again, maybe it combines it with what it hears tomorrow, and that could cause a reaction. All right, the VIX. Again, this is something I've been watching, and you had this big kind of reversal yesterday, and yet the VIX didn't move up very much. It was up a little bit with the drop in the market. It's up a little bit today with a little bit of the additional selling, but again, very compact. It's not really showing a spike, a lot of concern. Like I said, you could look at that two different ways. You could say that that those professional traders just aren't too worried yet. They don't think that this is a reason to panic. But you could also make the argument that they're not hedging and that they're not prepared. If we do have a shock, everyone's going to be chasing to buy those protected puts at the same time, and we're really going to see a spike in the VIX when that happens. Now, obviously, I think that both could be possibilities here, but the reason why I like this situation is that this is why I think if we do see a big spike in the VIX, that is going to signal a bigger warning. It's going to mean that those professionals aren't prepared, and that could allow us to immediately pivot into bearish type trades. In our case, those inverse ETFs, the SOXS or the SARK that we've been using. So we have ways that we can deal with it or even profit from it if it happens. But that's something to really pay attention to. Don't worry too much. One of the first things when I see the markets down, one of the first things I do is go look at the VIX, because if the VIX is flat or not up by very much, it's telling me that not to overreact to that selling I'm seeing on the market. Now, sometimes that can change. Sometimes suddenly the VIX will start to spike. It just comes a little bit later in the day or something like that. So I'm not suggesting you only check on it once when you have a down day and then assume everything's fine. But it's just one of those things you just kind of keep an eye on and pay attention to. Remember, the VIX is telling us my simplistic definition of the VIX is it's telling you the level of freaking out by the big institutional traders. Are they worried about the sell-off? If they are, they're going to go run out and buy those protected puts to offset the losses if the stocks they own start dropping. Well, they got to pay money for those protected puts, so they got to make that decision whether it's worth buying them or not. And if they do feel like it's worth buying them, that means they're concerned. That means that they're worried that this could end up being a little bit bigger drop. And so it can be an early clue that they're thinking they need to hedge themselves. Now, again, the assumption here is that those big institutional traders are always right, or they know exactly what's going to happen. I'm not saying that. I'm not saying they're always right, but they are plugged into this game better than we are. They've got connections we don't have. They've got computer programs that analyze everything you can analyze in the market better than you and I could ever dream. And they've got the money to move the market. They're big enough to move the market with their buying and selling. So whether they're right or wrong is almost irrelevant. They could be wrong and start selling, and it causes the market to go down. And maybe ultimately they were wrong about that, but they caused the market to move because of their size. So we're going to pay attention to that. We're going to try to read what they might be doing, and this is one of the ways that we can do it. One of the tools that we can use to do that. Okay. Now, be careful. The VIX is not telling you something significant every single day. If you assume that it's telling you something dramatic every day, you're probably overanalyzing it. But particularly when you're starting to get big moves in the market or unexpected moves in the market, it can be very helpful in telling you whether I think we're okay or, boy, we really need to be concerned here. And so far, it's not showing me a big level of concern just yet. In fact, Friday, you had that big drop, and you saw the VIX actually go lower as the market had that bullish reversal start to come back up. It didn't close It didn't really close higher than where it opened, but the VIX dropped pretty dramatically. So it just told me not to be too concerned with that. Actually caused me to be a little more bullish going into the close on Friday, and that's why Monday was a little bit of a shocker to me. But this is you're always vulnerable to unexpected news. That Nvidia news probably should have come out during the earnings report. I can't remember when they reported earnings. Maybe they're coming up. Check on that here, see if I can see. Because this is what bothered me about Snap. Well, Snap had that, they reported, they lowered their guidance just a couple weeks after they reported earnings. And it's like, well, you had to have known that when you report earnings. Why didn't you tell us back then? Their earnings, it looks like, are coming up at the end of the month on the 24th. So that could be a valid reason for reporting early, that they're expecting some of that weakness pre-reporting. So that's not too bad. All right. What else are we watching? The chip stocks. This does concern me. This would be a big bearish thing as far as the expectations that we're going to break out here. We should see the chip stocks breaking out first. Now, I talked about how this was significant to me, breaking to a higher high right here. Even though we didn't break above the June highs yet, it looked like the chip stocks were stair-stepping up, acting like an uptrend ahead of that. Well, look, we haven't broke above the June highs, and we've got this big drop today. A lot of the chip stocks are getting hammered. We're at the lows of the day. That would be a pretty big bearish argument, especially for the tech stocks. And, talk about the Nasdaq 100. The Nasdaq 100 just barely broke out, and now we're seeing this weakness in chips. So I got to pay attention to this. If we see chips continue to drop, then the market is not likely to break out right here. We're likely to get a deeper pullback, maybe not a panic sell-off, but maybe a deeper pullback. If it rebounds pretty quickly, and I thought maybe it was going to rebound, had an indecision candle yesterday after that bad news came out with NVIDIA. I thought it could rebound maybe pretty quickly from that. Today's pretty ugly. It hasn't dropped to a lower low yet. You got higher highs, higher lows through here, so you're hoping that this holds. You got a lot of support in this area right here around 220 on the SMH. Can you get a bullish reversal candle and a bounce off of that? That would restore my confidence that we could break out and rally. And again, maybe they're looking at that CPI number tomorrow to make that decision. But we can't ignore this breakdown in the chip stocks. If you were to draw a trend line up through here, we broke the trend line on today's move. A real big bearish signals if we start dropping below 220. This is pretty about two. Is that two? Maybe it's, what is this high right here? So about 2.8. If we get below 218, is you could draw a trend line right around here. 218 would be just below that. That would be pretty bad. But we want to pay attention there. This could be kind of that canary in the coal mine type scenario. It could be something that is signaling that there could be problems ahead. Now, remember what I always say with leading indicators, it doesn't always mean they're immediate. Maybe this rebounds and the market rebounds. You remember my argument with the S&P is it's important to remind you of this too, because there's new people that join all the time. I think the market's going to break out here. That's been my opinion, just because the market mood and these other things these other indexes breaking out. But I don't expect this to be the bottom. I'm not expecting that we're going to rally up to new all-time highs again. I think we could go on a pretty big rally that sucks people back in, that turns the market more bullish, gets people chasing, and then I do expect to get a panic sell-off that really crashes the market back down. So I don't think we're out of the woods as far as correcting and having another big move down. Now, it doesn't necessarily mean that we have to go below that June low. We could get a panic sell-off that ends up having a higher low, and that would actually be pretty bullish. It drops very dramatically, but doesn't go below that low. But I do think that we're going to get. I do think we're going to get a bigger sell-off here coming up. I just think it's going to come from a little bit higher position, and the market's going to think they're out of the woods, and people are going to turn a lot more bullish, and then it's going to happen. So that's kind of my thesis right now. So going back to the chip stocks, it could mean that it could mean that this was a break of trend right here. Maybe maybe it attempts to rally a little bit. We see the market break out. Maybe chip stocks can't even get back up to this high again, and it rolls over, and maybe that's when everything starts breaking. I don't know. I'm just kind of going through some, we don't want to ignore this though. But maybe we see a deep decline, and then the market rallies and breaks out. We ignore it. We forget about the chip stocks, but maybe they just underperform on the rally. They don't really participate and break out to new highs on the rally. That would be a real signal that we could look at and pay attention to. Is hey, don't trust. We're going to trade this rally, but don't trust it completely, because we could be heading for that bigger drop. So we're gonna pay attention to these chip stocks. We'll see how they behave, and we're going to pay closer attention to them now that they're breaking off a little bit from the rest of the market. Transports, now transports did break above that June high. We're comparing these to the Dow Industrials. Again, for those that are new, I'm not going to cover this every week when I go through this update here, but if you want to understand the relationship of the Dow transportation stocks to the Dow Industrials, go Google Dow theory, and you'll get plenty of articles that teach you about Dow theory. And now I will admit that the Dow theory isn't maybe as significant today as it was in the past. A lot of people think that the relationship of chip stocks to the Nasdaq 100 is a little bit kind of replacing the Dow theory. I still think both can be used, and both have been significant. I still use the Dow theory, and it still has given me solid clues as to how the markets could trade, and so I continue to use it. Again, but I think it's people that put too much emphasis on any indicator. That's where the danger is. The more clues we look at, I think we get a better, well-rounded conclusion as to what the market trend is when we do that. But transports had a bearish reversal candle yesterday after breaking out. Another down day today. That's something to keep an eye on as well. Does that continue? And then Bitcoin, again, still kind of moving sideways here. We're still trying to figure out if it's kind of forming a base or if it's getting ready for another impulsive move down. I think if it breaks below here, that'd be very bearish. If it can break back above here, that'd be more bullish. And we're still kind of in the sideways range, which we've been in for the last couple of weeks, so it really hasn't been much of a change there. All right. As far as the portfolio is concerned, I did get out of a couple trades. Obviously, NVIDIA. Just my luck that I get into it. And the reason for this, and I told you this, I said I could wait for it to break out above here. But a lot of times the risk is when you wait for the breakout, you get a big move on the breakout and you miss a big chunk of a move. That was the risk I was willing to take, to get in maybe a little bit early. Obviously, it gapped down yesterday. I wanted to see if it would build on, because it had a little bit of a bullish reversal, or more of a bullish indecision day where it opened lower, it closed higher than where it opened, but still off the highs of the day. That behavior is more indecisive, but I wanted to see if it would it would start trying to fill in this gap immediately. As soon as it didn't, and it moved lower today, I got out. My stop was down below here, so I stopped out a little bit early, but I just didn't like the way it was acting, and I know with some of that, with the news that came out, it could still get hammered pretty quick off of that, and I can always get back in if we rebound and break out. I can always get back in. So, but I got out of NVIDIA, and I ended up getting out of ACET. This is a biotech trade. It actually moved pretty nicely at first. I got into it right here off of this little pullback. And my stop was down below here, and it started to move like it was breaking out. I wasn't too panicking on Fridays or Monday's move where it had a little bit of a bearish reversal, but today, again, it's looking like it can move down to these lows. Maybe it retests these lows. I just didn't want to have a lot of long exposure here if this market does decide to fall apart. I don't like when I can't read a clear what looks like a clear direction. I know I can't know the market direction perfectly, but a lot of mixed signals, like I started out the update with, and I don't like to have a lot of exposure when I have some of those mixed signals, and there's still a lot of mixed signals. Now, I'm still holding RTX. Let me switch this to signals here. We are kind of just in this compact range right here. Again, we've had some of these big buy days that have taken place, but the stock just really isn't going anywhere. And a lot of that has to do with the market conditions. The market's been acting a little bit more sluggish lately. But I decided to continue to hold this one. My stop is down below these lows here, so I went ahead and held that one. And then the SPY, we haven't really broken down yet, and I think if we break out, this thing could run. So I didn't feel a reason to just panic out of that one just yet. But I did want to hedge a little bit, and so I did get into the SARK. Now, this is one of those inverse ETFs. We're going to look at the candlestick here. This has looked impulsive up right here. This has looked correct, and that's a deep retracement, so I'm not suggesting that this is overly bullish, but it did have a bullish candle day. These are small cap stocks. Kathy Wood's fund, the ARK Innovation Fund, it is the opposite of her fund, meaning this fund is shorting those stocks that she's in. Obviously, if interest rates continue to rise, it's going to continue to put pressure on small cap stocks. People are avoiding speculative companies. Now, again, a lot of this could hinge on that CPI report tomorrow. If it does look like the Fed's going to get more aggressive with interest rate hikes, you should see this go up. If it doesn't, then I think that the other stocks are going to go up, and I can just jump right out of this again. But it hedges me a little bit. So if we see the market drop suddenly, this should go up in value, and so it'll offset that. Now, again, the problem with this type of trading is that you have an up day and you're making money on S&P and RTX, but you're losing money on SARK. It kind of offsets it a little bit. This is why I only like to hedge like this when I'm in an indecision type period. If it looks like we're moving up, it looks like we're going to move up, I immediately want to get out of the SARK. I don't want it to continue to work against me. I don't feel like I need the hedge anymore. On the other hand, stocks fall a lot faster than they rise. So if there's a big sell-off off of that report tomorrow, these are going to get tanked, and this SARK should spike up and offset that. So it shouldn't hurt me too bad if I'm wrong. The other thing is to get out of everything, be in cash, wait till see what happens to that CPI report, then start to add back in. That's another thing that's a real easy thing you could do, is just get on the sidelines. do I have anything to add to go over today? I do like to have some things to talk about. Not that I would really want to be getting into a whole lot. I know a lot of you join these classes for some sort of trade ideas. If you go into the muscle stocks, there have been some pretty good trades coming out under the new buys. I like this CPSS right at the top, 99 strength rank. Let me switch this to signals here. You got kind of this bowl-shaped move, had this pullback, and then had a nice move up yesterday. A little bit of that's kind of a little bit of a bearish candle today. Maybe you could wait for a breakout above this high as a little bit of confirmation. In case this is wave A, wave B, wave C, and then it takes off. But I like the fact that this is kind of looks like it's moving up the right side of the bowl. One of my favorite patterns to trade. And then the other one would be the next one down, STNG, Scorpio Tankers. This would be a transportation trade. Had this recent pullback right here. Looks like it's breaking out again. And that could be one where you're buying the breakout. Nice uptrend. You could even consider a stop right below here. That'd be a good place for a stop. Because that's where you would know you were wrong if this breakout fails. But that's a nice looking chart. All right, that's all I have. Now, so we'll see what the CPI number looks like tomorrow. I believe that comes out right before the market opens. Some of these reports, I don't know the time. I do know some of the timing. I know when the Fed meeting stuff comes out, but some of these reports I don't always. I know they come out right before the market opens. I don't know the exact time because I don't usually pay attention to them. I don't. I don't really base my decision on what the report is saying. It's what the reaction to the report is. So all I care about is what happens when the market opens. We should see, well, now be aware though that there can be a kind of a false move in that first half hour, first hour. So if the market opens lower, don't assume that's going to means the market's going to be negatively reacting to that report. It could be kind of what happened on Friday, where it gaps down and starts rallying up off of that. But I would say that as you get to about noon Eastern time, whatever the reaction is at that point is probably what the reaction is going to be. You're probably beyond the whipsaws at that point and can make a little bit better decisions. So I'll probably wait till the end of the day tomorrow to make any trade decisions that I'm going to consider. But that's usually what I like to do anyway. All right. Thanks, everyone. Have a great week. We'll see you Thursday for the stock specific class. Bye now.